Coming up, the IMF says the Reserve Bank should lift interest rates while adding that Australia's economy is one of the world's most resilient. And we preview the US Federal Reserve's interest rate decision. That's next. It is your daily 10-minute business and finance news wrap for this Wednesday, the 1st of November 2023. Later, we'll speak with Hebe Chen from IG Markets to find out what happened on the share market today. But first, to the Australian economy and the IMF, which says the RBA should lift rates while the government curb infrastructure spend to ease inflation. It's part of its annual assessment of the Australian economy. And I spoke with its mission chief to Australia, Abdoul Aziz Wane, for more.
The word to describe the Australian economy at this juncture of the cycle is resilience. Australia has shown resilience to tighter financial conditions, and resilience also to high inflation. And this is also true if you compare Australia with peers. Australia indeed stands out as the most resilient, or one of the most resilient economies among advanced countries. This has some counterpart in terms of hardness of the economy, in terms of the level of prices. But I mean, to respond squarely to your question, resilience is really the word that describes the Australian economy.
Okay, so the IMF says that more needs to be done to bring inflation down. Can we split it up? What's the role of monetary policy? What would you like to see done?
The economy is hot, is operating above potential. So in light of that hotness of the economy, the advice is to tighten monetary policy, particularly to continue basically the tightening cycle that the authorities have started in terms of monetary policy. And for fiscal policy, the advice is to play a supportive role to help the RBA deliver on its mandate to stabilize prices. But at the same time, this could be done in a way that does not put the economy into a recession. So it's a very, very, very fine balance that the RBA authorities and the fiscal authorities need to strike here.
What's the risk then of not lifting interest rates?
Yeah, if interest rates do not rise, what could happen is that inflation or prices can remain very high. And as you know, high inflation hurt everyone, but hurt really disproportionately people who are at the lowest segment of the income distribution. So this is really not a very good. It's not a very good outcome for the economy in terms of inequality. It's also not a good outcome for the economy in terms of visibility for investors, right? If you want to invest in an investment project, you want to know what the prices will be in the future. And high prices, high volatility of prices is not a good indication, is not a good thing for an economy. So it's important for the authorities to stabilize the economy and give an environment that is conducive to private investment, but also to consumption for households.
Okay, that's monetary. What about the fiscal side of the equation? To what extent has the government been working hand in hand with the RBA, and is there more than it can still do?
I think the government has done quite a lot. When I say government, I'm talking about the consolidated or the general government, including the Commonwealth government and the state government. They have done quite a lot in terms of supporting the work that monetary policy is doing to stabilize the economy and stabilize price and bring inflation down. For example, the fiscal authorities have received quite a lot of windfall revenue coming from higher commodity prices, but also coming from the very dynamic job market. They could have spent that money. They have not spent it. They have banked that money. And the Commonwealth government has delivered the first fiscal surplus, I think, in 15 years. So this is a great achievement. Obviously, it's always possible to say more can be done, and the authorities, I believe, are are working in that regard. The fund's recommendation, the IMF's recommendation, is for the fiscal authorities to consider opportunities for reprofiling the investment portfolio. We recognize the importance of investing to support productivity growth, to support the green transformation, but at the same time, this should be done in an environment that does not add to inflationary pressures, right? Because this can be counterproductive, and we think that there's some role for the Commonwealth government to organize a coordination of these investment spending programs.
I'd like to touch on a couple of other key parts of your mission statement. Firstly, on the housing market. You touched on rents and the limited housing supply. Is this a global issue or something pertaining to just Australia?
You know, the increase in prices is a global issue. This has followed significant monetary and fiscal surpluses at the time of the COVID. It has also followed the disruption in global value chains coming from heightened geo-economic fragmentation or geopolitical fragmentation. So this increase in prices is a global issue. But lately, with the normalization of supply chains, goods inflation has come down, but service inflation is still significant and very high, right? In service inflation, this is the case in Australia. This is also the case in many countries. So the authorities are across the advanced world are having quite a lot of difficulties in bringing down inflation of services, especially rent inflation. So this is not a unique feature of the Australian economy. What I have learned actually from spending some time in Australia is owning a house in Australia is pretty important. So the mortgage sector is very important. It seems like there's a 1/3 of people who hold a mortgage, but there is also actually quite a lot of other people, especially at the lower end of the income distribution, that are renters. So higher inflation, higher rent inflation hurts these renters, but at the same time increasing the mortgage rate through the increase in the cash rate hurts also mortgage holders. So there is again another another balancing act, right, that the RBA needs to walk through to find really the right position in terms of interest rate and monetary policy.
The one thing we haven't talked about are external factors, things like China, the higher oil price and geopolitical tensions. Just how much of a risk to the Australian economy are they?
We see growth risks relatively balanced, right? Upside and downside risk. Downside risk coming from, for example, the external sector, coming from China, a downturn in China, an aggravation of the property sector challenges in China could have an impact on demand for Australian products. This is a significant risk. Also, as we were talking about at the beginning of the conversation, further geopolitical fragmentation and conflict in other parts of the world can have also an impact on Australia, on the demand of Australia product, but also on the global value chains, right? And this will definitely impact Australia. But it actually, in a sense, goes both ways, because Australia is also a producer of coal. Increase in energy prices can also impact Australia through the prices, even though it can have an impact also on the volume side. But external sector risk are on the downside at this juncture. But what we have discussed also during that mission is that Australia has actually over the years developed resilience and capacity to adapt to these shocks, especially shocks, for example, from China, by developing alternative markets. And this is again bringing us back to that first words about resilience of the Australian economy, and the authorities and the Australian people should be commended for achieving this.
Finally, it might sound like an obvious question, but what do you see as the key risk to the Australian economy?
The key risk to the Australian economy, we have talked about it in terms of longer-term issues. Climate change is an important risk, not only for Australia, but for many countries. The authorities, I think, are sort of working to develop policies to address this risk. But at the same time, productivity decline, also an issue that is not unique to Australia, but that we have recorded and documented in many advanced countries. The 2-decade-long now decline in productivity growth needs to be addressed. But Australia, I believe, has the policy it needs and has the resources it needs. This immigration, the uptick in immigration that we are seeing can help boost productivity, can help also address other challenges of the Australian economy, including the aging population, and boosting growth and shared, sustained prosperity for the Australian people.
That is Abdoul Aziz Wane there from the International Monetary Fund.
Now, Market Day on the SBS On The Money podcast.
The Australian share market rose today. The S&P ASX 200 up by 0.85%. That's our second day of gains in a row, following a fall on Monday, which sent the share market into a technical correction. So what's happening? I spoke with Hebe Chen from IG Australia.
Yes, indeed. I think the Australian market doesn't have a good month in October as well as last week, and it dropped up nearly about 10% from its peak. While we do see a bit of the stabilizations into the new week, but I think it's more rather than sometimes a technical bounce back when the deep buying opportunities appears to be appealing for some of the investors, as well as we call a new month's optimism that people are seeing, taking a bit of a wait and see what the new month could bring. However, fundamentally, I would say is that what sort of the headwinds that we're seeing in October will likely to stay in the new month. So I think investors be better prepared for the similar volatilities continue into the new months.
I think one of the key things to happen is the US Federal Reserve meeting on interest rates. I think we'll have a decision on Thursday morning. What's the market expecting and what are the implications?
So pretty much markets is expecting a no change or a pause in tomorrow morning's decision. So what that means that if a pause being confirmed by Fed, and they're very likely to be the question about what is next. And now the market is only seeing a 30% chance for a December hike. But if there's no hike in November's meeting, that will pretty much give rise to a chance for a December hike. Apart from that, I think what also market been focused on is what the Fed stance that they're going to do for the new year, for the next year's outlook, as well what they're going to do with the inflation issue.
Okay, speaking of central banks, the IMF says that Australia's Reserve Bank should continue to lift interest rates to beat inflation. What's the market expecting?
Yeah, so what basically IMF saying is they're not seeing the inflation in Australia will return to its target range within its target timeline. And that's pretty much taking reference from last week's inflation data. And the market now is seeing that RBA will very much likely to increase another 25 basis points in next Tuesday's meeting. So I think what IMF said today is pretty much give RBA a good reason to follow what the market's expectation. But what also that market not yet expecting but could potentially happening is that after another 25 basis point, will RBA saying that this is a peak, or they will just keep emphasize that they are seeing a more hike to come? I think that will be quite of a big wild card that we are expecting for next week.
And given all that volatility that you've warned may happen in that first answer, where do you see the opportunities for investors then right now?
Well, at this moment, I will be quite cautious about the particular markets because we know there's a lot of things happening. But I do see some of the opportunities approaching. That's especially for some of the big players. They got punished by the very picky investors, especially for some big players like Alphabet, like Apple. In Australia's case, like a Real Group, they are not yet to seeing that their fundamental picture has been impacted, but their share price, all of the share price dropping about 15%, even more than that from its peak. And they are opportunities potentially when the market getting more stabilized. In the Forex market, I believe the Japanese yen will continue to be a hot target for most investors. In the short-term view, I do see that the USD versus Japanese yen could potentially keep pushing up. However, I think in the long-term view, I think that 2024 will definitely be a year for that we're seeing a coming back of Japanese yen.
Hebe Chen there, market analyst at IG Australia. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.